Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined the show for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Always excited, always a lot to talk about. And today we're going to cover off some news from the top end of town. We're going to talk about the Magnificent Seven stocks. Less magnificent than they were to start the year, but magnificent nonetheless, I think you'd say. Then we're going to talk about the power of long-term investing and importantly, how we answer the question, when is the right time to invest in a market downturn?
Sounds good.
And then we're going to close out with one of our favorite segments. Pimp My Portfolio is back, but with a new expert.
Yes, very excited to be introducing Matt Ingram from Northhaven, my financial advisor, potentially soon to be yours, Ren, but he is here for the first time on Pimp My Portfolio.
Nice. We are not pimping Bryce's portfolio as much as I wanted to do that. But yeah, excited to chat to Matt. But let's get stuck into the news.
News and markets.
We're going to kick off with a look at the divergence that is playing out, Ren, between the S&P 493 and the Mag 7.
Yeah, now the Magnificent Seven are the seven big US tech stocks. Well, the six big tech stocks and Tesla. But we've got Apple, Microsoft, Nvidia, Meta, Alphabet, Amazon, Tesla, the big seven. And for years, the narrative has been the Mag 7 are driving the index. You know, all of the S&P 500's return is a Mag 7. We've never seen such a big divergence between these seven stocks and the rest of the index. These seven stocks are covering up all this weakness in the US economy. We heard it over and over again. It was like the dominant narrative in US markets, I'd say, really coming out of the COVID period and beyond.
Yeah.
That changed this year.
Yeah,
that changed.
So we've got a chart here that sort of shows how the performance of the Mag 7 and the S&P 493 has changed or has played out over the last quarter. So this is from Jan 25 through to the end of March 2025. The Mag 7 down 15%. So in not quite a correction, but the S&P 500 outside of the Mag 7 is actually up 0.5%. Call it flat.
Now, this was before Trump's Liberation Day tariffs, so
Yep.
you do have to take this data with a grain of salt. But that divergence that has gone the opposite way of the previous years, where the Magnificent Seven's massively underperformed, has continued. You know, we've seen Nvidia get punished. We've seen Tesla get punished. So it's just an interesting, I guess, nothing in markets lasts forever. And the outperformance of the Magnificent Seven was never going to last forever. And, you know, things kind of switched at the start of this year, even before the tariffs. So interesting trend to watch. I think everyone's feeling the pain at the moment, but people who are equal weight will be feeling a little bit less pain than people who are market cap weighted.
Yeah. Well, yeah, definitely. If you're interested in an equal weight, there's one that we've spoken about. It's QUS. It's the BetaShares S&P 500 equal weight. I also think Global X have an equal weight as well. But speaking of big tech, Ren, Mark Zuckerberg took the stand last week in the Meta antitrust trial.
Yes.
They're digging up the purchases of Instagram and WhatsApp almost over a decade ago.
2012 for Instagram, 2014 for WhatsApp.
And now looking at it in hindsight and saying, damn, we shouldn't have let that happen because they're now certainly a monopoly. Of course, Facebook is saying that this is obviously BS because we're competing with YouTube and Snapchat and TikTok and all the like, which is fair enough.
I read part of their court filing that it's like the Chinese-owned TikTok is how they describe it. And they,
Let's try and separate from America.
Well, and then there's language around like trying to, constrain great American technology companies and like lose America's edge in the AI race.
Oh my God.
It's just like,
oh my God.
Yeah, I don't think it's controversial to say that like they are obviously playing to a particular audience.
100%. Yeah. 100%. Yeah.
But the interesting thing is this FTC case was started under the first Trump administration. So
it's been going for ages.
Yeah. But the FTC, the Federal Trade Commission, want to break Meta up. They want to break them up into their three constituent parts: WhatsApp, Instagram, Facebook. It's interesting. Zuckerberg was the first witness called. He's never a compelling speak up.
No.
But there was some interesting stuff. Like there was commentary, or there was evidence from the time around the Instagram acquisition that they had planned to just buy it and just let it die. But then they saw how popular it was, and they really invested massively in it. It is a little bit of a hindsight question because Meta was so successful with these platforms and able to grow them to such an extent, it's now
it's
like they want to break it up, but it's like
it's like you had the opportunity at the time just because they've grown it into a phenomenal business.
Well, no, like at the time it was considered a joke. I remember there's this there's this Jon Stewart clip which we put on our Instagram before years ago when this case first started, of him just absolutely ridiculing Meta buying a photo sharing app that doesn't make any money for $1 billion. Yeah.
So it's a bit BS. But anyway, the point that we're getting to is that it's got us thinking about companies that have been broken up and the opportunities that present for shareholders.
Yeah, because it may feel like it's a terrible thing for investors. There hasn't been a heap of regulator breakups, but when they do happen, they're often pretty good for shareholders. So 2 examples, both from the US, both 50 years apart or more than 50 years apart. Standard Oil is the classic one. So this was John D. Rockefeller's oil refining monopoly. And it was broken up by antitrust regulators in 1911. He owned about 25% of the company at that time. And it was worth, depending on the share price, between 300 and 400 million, his stake in the company. The government broke it up into 39 different companies. And some of those companies became the oil giants that we know today. Exxon, Mobil, those 2 merged later. Chevron, Marathon Oil. Like this was the dominant company. There was a monopoly, truly a monopoly. So broken up in 1911, call it $400 million, his shareholding. 2 years later, 1913, worth $900 million.
Crazy. Yeah.
More than doubled his shareholding.
Yeah.
Similar story plays out with AT&T. So Alexander Graham Bell invents telephone. They create a telephone monopoly across America, lasts about 100 years. In the 1980s, the US government finally is able to break it up. In the 5 years pre-breakup, the stock was growing at like 5 or 6% a year, like pretty slow growing. 5 years post-breakup, the collective shareholdings of all the different shares grew more than 15% a year.
Wow.
Between 1984 and 1996, those shareholdings returned 16% a year with dividends reinvested, which outpaced the S&P 500.
Release the value.
Yeah.
I'm trying to think though, like I reckon in our entire years, in our years of investing, since doing this show even more, there's just been case after case of trying to break up companies. But I don't think in our lifetime there's been a significant breakup of a company.
Yeah, I tried to do,
A lot of chit chat.
Yeah.
A lot of chit chat.
A lot of chat about Google is another
Amazon
one.
also was always around there, AWS and bits and pieces. But
and if you're trying to think like what's the mechanism for why these companies outperform, just like the simple example, this wasn't a regulator breaking it up, but like the Woolworths demerger with Endeavour.
Yeah.
So that was a voluntary breakup, demerger. But if you think about the story around Endeavour at the time, it was that they were constantly competing for attention and capital and resources with the Woolworths business, and Woolworths was just often seen as the better place to invest money.
Yeah.
So the Endeavour Group pubs were seen as like underinvested in and scrappy and stuff like that, and by separating them, then Endeavour gets its own board, it gets its own bank account, it can make its own capital allocation decisions, and it can pursue its own strategy.
Yeah.
And
well, it was the same with Wesfarmers and Coles.
Yeah, you're right.
But it was like Bunnings v Coles. We want to be putting all of our capital into Bunnings and Coles. And I mean, Coles has done well post merge. Demerger. So
the sneaky thing that a lot of what Wesfarmers did while it owned Coles was sold a lot of the land that Coles owned and then rented it on long-term leases and used the capital it freed up from those sales to invest
In Bunnings.
Well, yeah.
Well played.
Yeah, it was well played. But look, I think that's just there's some examples. There's not, as you said, there's not a lot of historical examples, but it is an interesting thing to just keep in mind as this story plays out because meta investors today, I think it's unlikely that it gets broken up, but if it does, may end up owning Instagram outright, WhatsApp outright. It would kind of suck if WhatsApp gets split out because it doesn't have a good revenue model at the moment.
Yeah, it could change it quite dramatically.
Yeah. And then just to close out the story on Meta, I just finished that Careless People book.
Yep.
You know, the one that Meta sued Sarah Wynne-Williams, who was their former head of global policy.
Yes.
To stop. She'd already published it, but to stop her book tour and stop promoting it.
Yeah.
But classic example of the Streisand effect in suing her and winning that case. It got heaps of publicity, became a bestseller. Interesting book. Like, there's a lot in there around Meta's interactions with world leaders. You can understand why Zuckerberg didn't want it getting out. It paints him in a pretty terrible light. Paints Sheryl Sandberg in a pretty terrible light. We
should caveat, or at least that this is a pretty divisive book in terms of people questioning the colour that has been put to some of these stories.
I was going to get there because it paints them all in a very terrible light to the extent where like Sheryl Sandberg is now being spoken about in like Me Too conversations.
Yeah, wow.
But it is a classic example of someone writing history the way they want it to be told. You know, Sarah was there for all of these terrible things, and she paints herself as the only voice in the room who was against these things. And I reckon if you read the second half of the book, there's just constantly, this is when I knew I had to quit. But then it's like 1 year later, I'm in Myanmar working with the military junta, and it's like, didn't you say
why haven't you quit?
And then it's like, oh, but then this, now I realized I need to quit. And then she just stayed stayed. To the extent where, and this is, I mean, she got fired. She didn't even quit at the end.
Right.
Yeah. So, I don't know.
Wrote a book about it.
But it is like, to her credit, she kept receipts. Like, there's a lot of verbatim quotes from emails and stuff like that. So you can't argue with that.
Yeah.
But yeah, I would recommend it because it's interesting.
Nice. Yeah. All right. Well, we'll put a link to the book in the show notes. Careless People, bestseller. Now, if you'd like to keep up to date with all of the news headlines, make sure you subscribe to our daily newsletter. Every morning, 6 a.m, straight to your inbox, a summary of the important headlines that are making markets move around the world. And if you want to listen to those headlines in podcast form, the podcast Headlines by Equity Mates is available in your podcast player now.
Buy the dip, the saying goes, but when is the right time to buy the dip? We've had a look at some research to help us think about when is the right time to buy as the market falls.
Yeah, this is a question that we get all the time. Buy the dip, which is great.
All the time, particularly at a time
like this. Buy the dip. But is now the dip? When's the dip? Should I buy now?
So before we get to the timing, let's just, for people who are newer to the narrative around buying the dip, just some data to just explain why we say buy the dip, why it's such a common phrase. So this is research from Ritholtz Wealth Management, and it looks at the S&P 500, so the American index, returns after a 15% drawdown. So after the market has fallen 15%, how does it look on average 1 year later? On average, it's up 15%, and 83% of the time it's up. 3 years later, after a 15% drawdown, on average, it's up 41%, and it's up 96% of the time. After 5 years, on average, it's up 66%, and then it's on average up 92% of the time. 92 in total, 92% of the time it's up. But this is where the data gets really exciting. This is why we love long-term investing, because after 10 years, on average, the market is up 186%. So you've almost tripled your money, and it's up 100% of the time.
No brainer.
You can't find
you can't lose.
You can't find a 15% fall in the S&P 500's history where you go forward 10 years and you're still down.
Love that. I mean, the stat we always say is 20 years, but we need to be dragging that in because that's what you need to be showing your friends every time that there's a market dip and people are telling you you're crazy for putting money in.
Yeah. So the question then becomes, when's the right time to buy the dip?
Now.
And that is really that's the message we want to get across. The market, the name of this segment is The Market Doesn't Wait.
It doesn't. And what we're like, so I guess to just unpack that, a lot of people are thinking at the moment, well, you know, how can we be at the bottom of the market when the tariffs haven't even kicked in at the moment? This seems wild. We've had this drop. Trump's done all this crazy stuff, but we're really not actually seeing anything implemented at the moment. Surely there's more to come.
Yeah, surely company profits are going to fall. Surely the economic, the overall economic activity will slow down. Surely there's more to come.
Yeah, and they're right. They are right. Yeah, I mean, there could be more to come. But the thing is, the share market is all about looking forward.
Yes.
It's about looking not just tomorrow, but like what is. Look, it's a forward looking. It's trying to pick. It's telling us about the future.
Yes. So data from 2020 to illustrate that point that the market is forward looking. So the S&P 500 bottomed in March 2020. GDP in America bottomed 3 months later. And then earnings per share, so companies' profitability, actually bottomed 13 months later from the S&P 500 bottom. That is the market being forward looking. It's not trying to pick where marry up to where like companies' profits will fall. If it sees that profits will fall, but then they'll rise after that, it's looking out. It's looking in those out years and beyond that. And so that's why the market doesn't wait. That's why the market moves first before the economy and before companies. And so if you'd waited until companies' earnings had bottomed out, you would have missed the rebound. The S&P was up more than 60% 13 months later. It was up more than 25% from where it was before it crashed.
Yeah, I mean, this is why trying to time these things is near impossible.
And you might argue that, well, 2020 was an outlier. Like, it was so different. There was so much different stuff going on. That's not indicative of how the market always works. Well, let me take you to every bear market since 1957. Every time the market has fallen 20% or more in the last 70 years, on average, earnings bottom 9 months after the market bottoms.
Yeah.
So this is why the market doesn't wait. And this is why as investors, you can never pick the perfect time. But this is why so many investors miss the bottom, because they try and wait until the company news has turned.
Yeah, when the news hits rock bottom, it's too late.
Yeah.
Yeah, it's like... and look, things are definitely going to continue to play out in markets at the moment. Who knows what Trump's going to come out with? He could come out with news that is worse than what people are now expecting. And we could continue to see markets fall. But yeah, our message here is don't wait, just dollar cost average.
Yeah.
Take those opportunities.
Yeah. So look, putting that all together, returns after a 15% drawdown historically over the long term,
Love
that has been a good time to buy. And we're more than 15% down at the moment. Over a 10-year period, the amount of times that you're up is 100%. And in terms of when the right time to buy is in the market dip, you never know when the right time is, but the market turns before the news turns, before the economy turns, before companies' fortunes turn. And so you're never going to be able to nail the right time because the market turns first. And so because it doesn't wait, we are saying that you shouldn't either.
I would be writing that stat down in your phone, tattooing it on your arm, wherever you need to write it down, so that when a moment like this happens again and there is an emotional drop of 15%, you remind yourself that there has never been an instance where after 10 years you would have lost your money.
Yeah. Now,
that is wild.
We've been trying to explain some charts here. So what we'll do is we'll include these charts in an Instagram post the day this episode goes out. So you can have a look at them. But I think that's a reminder of the power of long-term investing, the power of staying invested, and the power of doubling down in these buying opportunities.
Big time. Hope you're making the most of it. Well, we're going to take a very quick break. And on the other side, as we said at the top, we're introducing Matt Ingram from Northhaven. He's going to be our expert, taking a look at one of our community members' portfolios as part of Pimp My Portfolio. We'll be right back. Welcome back to Equity Mates. It is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. We have a listener on the line and an expert in the studio to review the portfolio of our community member today to help them make some small improvements. On the line, we have Aman. Aman, how are you going?
Good, guys. Good. Thank you for having me.
Anytime. And in the studio for the first time for Pimp My Portfolio is financial advisor Matt Ingram. Matt, welcome.
Yeah, thank you. Excited for this.
Yes, no pressure. So, Ren, as always, do you want to take us through Aman's portfolio?
Yeah, so Aman has a number of ETFs, a few key shares, and then some crypto. I would imagine a bit of a core and satellite approach. Just shy of 90% of the portfolio is in ETFs. Some of the bigger holdings, the S&P 500, IVV, Vanguard International shares, and then a number of Australian share holdings, Vanguard Australian shares, Beta shares A200, SBDR, ASX 50, Vanguard Australian shares high yield. Then we've got India, Nifty 50, we've got some gold and Australian property. So there are a number of ETFs to kick things off. 4 shares, MinRes, Viva Energy, Disney, and Alphabet. And then closing it out, some crypto, Bitcoin, Ethereum, and one that I certainly have a question about because I've never heard of it before, Aman, and that is Polkadot. So before we get to how the portfolio came to be, Matt, do you have a nickname for the portfolio?
Yeah, so this one is pretty US-centric, so I've called this one God Bless America.
So Aman, give us a sense of how this portfolio came to be.
So when I was trying to pick different ETFs, and I was introduced to just index funding fairly early in my life. I was very pro US, given the fair share of how it has performed in the last 10 years, not essentially 100 years compared to ASX 200. It was a no-brainer. I wanted to be my core to be sitting with the US markets, and then had a bit of a background in the Indian stocks, which there's mutual funds that are quite popular back in the country. I just wanted to replicate the same idea and the strategy on ASX. That was pretty much it. And then I wanted to dabble around crypto here and there. Just to keep things spicy, and that's pretty much it. Yeah, it was a no-brainer, to be honest.
And before we get to Matt's thoughts, what is Polkadot?
Polkadot is another parachain which is quite popular. I'm talking about 3-4 years ago. It was supposed to take over Ethereum network, but then eventually it just sort of died down, and I'm just not selling it until I die, I feel like. So I think I'm going to just sit on it until my grave. It was promising when I invested, but I don't think so. It's there anymore. So,
Nice.
Yeah.
Well, Matt, what are your initial thoughts on Aman's portfolio?
Yeah, so look, as the name implies, obviously the first thing that jumped out was all these US ETFs, which makes sense now with a bit of context, Aman. But looking a bit closer, when you actually read through those ETFs and look what's under the name there, if you exclude cash from your portfolio, it's about 60% in the US. And with IVV, I mean, that's US large caps. VGS is 80% US large caps. GGUS is just leveraged US large caps. IHVV is hedged US large caps. And then U100, which is similar to the NASDAQ. It's basically innovative US businesses, ex-financials. It gives perhaps an illusion of diversification, but maybe not so much of the benefits, given a lot of these ETFs have the same names or the same underlying holdings. So nothing necessarily wrong with that. It might be a case of looking at how they performed, what they've done. Is there large capital gains on there? And if you wanted to clean it up, you could clean it up. But if it's going to come with a big tax bill with it, then there's nothing wrong with holding it as it is. But what I would flag is that, as I said before, without cash, it's about 60% of your portfolio is exposed to the US. And assuming you're based in Australia, this is where your currency is, perhaps your retirement will be here as well, maybe keeping a little bit of a larger allocation to Australian shares would make sense. Right now, it's only about 10% of your portfolio, so maybe bringing some of that home at some point.
What are your thoughts, Matt, on, I guess, even going further than just Australia and I guess more international exposure?
Yeah, so again, looking through the ETFs, outside of the US and Australia, there's about 7.5% of the portfolio is outside of that. Now, the US has done well for a long time, probably will continue to do well for a long time, but just sound portfolio construction would suggest that you should maybe get a little bit more outside of the US and Australia. So the US and Australia. So yeah, with that in mind, there's plenty of ETFs that do that as well. You've got VGS in there, which does have some exposure outside, but as I said, that's about 80% US, so it's not much. I prefer, instead of VGS, having something like IVV and balancing it out with VEU, which is ex-US, and then you just have a bit more control over your allocations. You can dial up VEU if you think Europe or Asia are going to do well, or you can dial up IVV when you're bullish on the US. Gives you a bit more flexibility.
And there are some individual. Well, I guess, what are your thoughts on that, Aman?
Yeah, I mean, I understand there's a bit of an overlap with a lot of ETFs because it's majorly just focus on US, and that was my strategy from the beginning. But I did put in NDIA, which is a fairly larger holding compared to, it's almost touching the allocation percentage of VGS. So I think maybe in the future I would potentially go forward with emerging markets ETF, which could sort of compile everything in one umbrella. But at the moment, I'm just on the fence because if you could see, I've got cash as well sitting there with the 5.4% yield on high savings account. So I'm just going to see and assess how it goes. And but you're right. There's a bit of an overlap, but it was on purpose.
So can I just ask, what's the plan for the cash there? Is that as opportunities arise, you're going to put it in, or are you long cash? Are you holding cash for a while?
Yeah, well, look, I'm probably gonna wait till, because if you look at 22%, I'm probably gonna look at 30%. Every time I reach 30% cash in my portfolio, then that's when I decide to look for places where I can invest and find opportunities. But yeah, I would move away from US for a bit and see if I can. Obviously, if my geared is down, I would get into the geared market and do dollar cost averaging. But at this stage, I'm just going to sit on it for a while. Because it's after a while, if it exceeds and my expenses are quite low compared to what I earn, that cash pile is going to shoot up pretty soon. So it depends how it looks like.
So one other question I wanted to ask Matt was around ETF overlap. So just looking at the US, there's IVV, IHVV, GGUS, and U100. But if we come back to Australia, we've got VAS, which is Australian Shares Top 300, A200, which is Top 200, VHY, which is Australian Shares High Yield, and then SFY, which is ASX 50. How do you think about that? They're all trying to do like slightly different things, but obviously there's a large amount of overlap there. How do you think about that? And if you were to consolidate them, which direction would you be consolidating in?
Yeah, look, I like to keep portfolios clean. So just having a bunch of names in there doing similar things, even if it's a bit different, probably just bugs me from a admin perspective, but that's because it's my job, right? I have to look at portfolios and when they're always messy. But that doesn't mean there's necessarily anything wrong with doing that. Where I would maybe consider changing a portfolio like this is, even though they're doing slightly different things, it's probably all going to wash out somewhat in the end. Unless you're really going for dividends. You guys have talked plenty of times about high yielding ETFs, and maybe the quality isn't necessarily there. They're just picking the highest dividend paying stocks and throwing them in there. So I wouldn't necessarily focus too much on that, especially if you've got a fairly high cash allocation. That's probably getting a decent return at the moment as well. In terms of whether you go, VAS or A200, it's much the same really. I like A200, but it really is so similar. So I wouldn't worry about changing that too much.
Well, I think, Aman, the takeaway here really is that there's, I guess directionally, it's try and move some away from the US exposure, shore up a little bit here in Australia. Think about something like VAU that is a little bit more international as well, because I think, trimming those lines a little bit, given that there's a fair bit of overlap in there. But it sounds like you're certainly on the right direction anyway. Yeah.
Look, and Aman, to be honest, there's a lot of good things going in here. Some of your direct names, I really like Disney. I think, Netflix has done well, and Netflix does well because, other streaming businesses have caught up. Netflix is making great original content. Who else in the streaming wars has great original content? It's Disney. So, and they have so many ways to monetize it. I mean, Mickey Mouse has been making money for 100 years now. So, really like Disney, really like Alphabet. Mineral Resources, look, that's had a rough run and continues to, but
that's my favorite stock out of all my whole portfolio. That's my favorite stock. Not even GGUS comes close. All
right,
goes down, comes up, goes down, comes up. Yeah. Wow, this is a ride.
If that's what you
Wakes
enjoy,
me
then
up in the morning every morning without the coffee.
Yeah. Well, long may it continue then.
Between that and crypto, you have plenty to keep you excited.
Yes. Yeah. Well, we might leave it there, Aman, but thank you so much for submitting the portfolio. I hope there's a few things for you to think about there. And but I think, as Matt said, there's a lot of plenty of good things happening in the portfolio. I guess if there's you just tinker with a few of the things, I guess to tighten it and consolidate it a little bit more. But thank you so much. We really appreciate you coming on. And Matt, thank you for talking it through with Aman.
Yeah, thanks, Aman.
All right, thanks, guys.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.